Is the audio synced? Okay, we can start. What's up investors, Sneers here. Today we talk again about ASOS. I feel like I talk about them a lot, which I do, but that's the nature of long-term investing. I keep researching and talking about the same companies for the long term. Today I want to talk about the last earning calls from a few days ago and the one before that, and the meaning of their pivot toward profitability, which will inevitably harm growth. As usual, this video is based on a post on my newsletter, which you can see right now, and if you prefer reading, you can subscribe to it with a link in the description below. First, I want to talk about my personal situation with the ASOS stocks so you will understand where I'm coming from. I started a big position on ASOS when it was traded at £12 per share. Right now it's trading for £7.5. But lucky for me, a few months ago, I doubled down when it was close to the absolute bottom at £5, which you can see now on the screen. That's the tweet I tweeted when I doubled down. And this doubling down made it so that with the recent uptick in ASOS from the last few days, I'm almost break even. So I'm starting the look at ASOS from ground zero. No bias for loss, no bias for win, because I'm almost at 0% with the stock. And I have deep dives into ASOS in the newsletter and on videos, which you can look if you want to go deeper into the business and the core of it. But in this video, I will only focus on the recent things that happened with ASOS. First, we need to talk about ASOS actions toward cost optimization. You can see here slides from the October 2022 presentation of ASOS a few months ago, which lay down the plans to cost optimization for the company. You can see here, for example, optimizing our logistics costs, reducing our overhead costs, and other things, which basically here to get the margins better and get them closer to profitability. The CEO detailed the plans more in the earnings call, saying we are going on our logistics costs. We are consolidating some of the ancillary warehouses, not the core warehouses. You can read it all in the newsletter if you're interested, but it's all come down to right now the earnings calls from a few days ago, in which they lay down some of the things they did. First, they are closing down 3 storage facilities in the US, UK, Europe. They are downsizing office space. They are removing 35 unprofitable brands from the site. They are limiting marketing spend only for good return on investment campaigns, and they are doing some layoffs. The next thing to talk about is the inevitable changes in the ASOS operations due to this cost cutting. But in ASOS case, this is a two-way thing. It's not only downsizing the operations relative to how much cost cutting they are doing, they are changing the way they work to be better ready for the new era we are going on in the next year. In practice, that means that we will focus on delivering value to the customers in a timely manner. That means they will no longer hold massive storage of stock that is depreciating, but they will focus on just-in-time delivery of the highest value, fastest fashion to the customer, which will inevitably lead to less storage need, but also to be more relevant to the customer. It means that products that usually target the long tail of customers, the edges, which can sit in storage for months until the right customer is arriving for them, this will no longer be the case. They will focus on the hits, what everyone wants to buy, and they will focus on transferring it within storage to the customer as fast as possible, which will result, of course, in lower revenue because you will give up on all those long tail customers. But those long-term customers currently for ASOS lead for lower margins and sometimes even losing sales. So ASOS decided to give up on them and essentially give up on growth currently to focus on profitability. Now, this will harm ASOS in the long term because all those long tail customers that come to ASOS because ASOS is the only one holding the stock for their needs will no longer come to ASOS, which means they will no longer be onboarding for the first purchase on ASOS, which typically down the line a few years lead to these customers be a profitable customer. Now, how all these changes affect in reality? I want to share with you the personal experience I have. I live in Tel Aviv, Israel, which is categorized as the rest of the world for ASOS. And I order from ASOS every few weeks just to measure the quality, to measure the experience, and see what changes. When I made an order in September, I got the order to my house within 3 business days, which means they sent it through air freight directly to me because it came from the warehouse in the UK. And the other thing is that I made this purchase in September through an ad I saw on Instagram. So they target me as a returning customer and they do this marketing spend on me. Compare that to my experience from 2 weeks ago. I made an order and it haven't arrived yet, which means they changed me from air freight to shipping by sea, and I'm no longer seeing ads for ASOS on Instagram, which means they canceled their marketing spend on my area. And that's great because it doesn't make sense for ASOS to spend so much on a market like Israel. Think about the margins they give up by doing air freight just so I will get my order so fast, and think about all the marketing spend they do on me. So giving up on this market will inevitably lead to lower sales because a lot of customers will not buy again from Israel, but it means higher margins for the sales that ASOS will make in better markets in the UK, in Europe, and in the US. Next, I want to talk valuation. Let's go back to the site. When we come to value ASOS now, we need to take into account the effects of our current actions. First will be better margins. Since they do all their cost-cutting measures, they will get better margins. They are currently at the operating margins, they're flowing around 0% from the negative side. They can come to its pre-pandemic average of 2.2%, but these profit margins were when they tried to grow very hard pre-pandemic and they spent a lot more money. If they are really going into the prudent way now, they can go much higher than this, and they can even go to 4% and maybe higher than that, and can go anywhere between 2.2% to maybe 4% or even 5%. The next effect we need to take into account is lower revenues. Since they will give up on all the loss-making markets and all the loss-making brands and things like that, inevitably the sales will go down. We already see it with the last report when they showed minus 30% sales in the rest of the world segment because they completely dropped marketing there and air freights. So I expect this trend to continue. ASOS currently sits on $4.5 billion sales in the last 12 months, but they will go down. The optimist in me expects $4.2 billion this year, but they can go as low as $3.9 billion according to the numbers I ran. They can go even lower, but that's the bearish estimation I made. Given all that, let's start with the easy PE valuation. ASOS' current market cap is $750 million. In the bullish term, $4.2 billion revenues and 4% profit margins, that means they are currently trading on a PE of 4.4 for the future revenues, which is super low. And if that really is what will happen, they can easily double or triple from where they are, because that's a very, very low PE for their situation. Now, if we go to the bearish estimation of $3.9 billion revenues and 2.2% profit margin, that means we are currently trading on a future PE of 8.8. This is no longer as clear cut as the 4.4 PE we saw here, but it's good enough. Companies at this situation usually trade for a PE of 12 to 16, but they can hover around 9 at this situation. And if that happens, it means they are currently fairly priced. Next, let's talk relative valuation. Lucky for us, Zalando is a fashion company in a similar situation to ASOS. They have depressed margins and shrinking revenues. And their margins right now are where we expect ASOS to be in the bearish estimates of around 2% per year. So that makes Zalando the perfect comparison for ASOS, at least in the quantitative way. So if we look at Zalando valuation multiples and compare them to where ASOS is traded right now, ASOS is traded at a price that is half to a third of the current valuation. For example, The enterprise value to revenues of Zalando right now is 1.01x, and for ASOS is 0.32x, which means that if ASOS gets to the same place as Zalando a year from now, which is our bearish estimation again, and gets the same multiples, ASOS can triple. Of course, my bearish estimates for ASOS might be completely wrong, and the results for ASOS a year from now may be completely catastrophic. That's a risk that is there for every company. But I think that my estimates are on the right direction, and the results from a few days ago shows that ASOS is in the right direction, and that's why the market jumped it 25% for the stock price. So if that will come to happen, I think we can expect the stock to double. At least that's my expectation. Don't take advices from random guy on YouTube. Please don't. But for me, I'm keeping ASOS as of now. I decided to not sell my stocks because I expect the risk reward here to be good enough for me, especially on my sizing. And that's it. I hope this was helpful, and check out the newsletter in the description below, and I hope to see you next time. Bye bye.